Good afternoon, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our webinar on basic charts. Today we're going to talk about how to use charts and how to build your foundation for trading or for beginning technical analysis by understanding and properly using your charts. Now, ETX is a regulated provider, and therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information that's provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Any securities we talk about are for educational purposes only. Now, for those of you that are just joining us through finding us through the internet, ETX is a regulated provider, and we are a fast-growing financial services company based in the City of London, and we're also a member firm of the London Stock Exchange. We offer many different ways to trade on our various platforms. If you're a beginning trader, maybe you should start out with ETX Binary, or if you're looking for a new way to find or expand your portfolio, ETX Binary might be a helpful way for you to trade. We also offer CFD trading, spread betting if you're based in the UK, as well as Forex trading. You can trade commodity stocks indices. You can use our web-based trader, our ETX Pro, or get our elaborate MT4 platform that'll even allow you to hook to it expert advisors, as well as will help you build your own automated trading system. You decide what and how you want to trade, and we will offer you all the tools and the best trading platform in the markets. Now today, we're going to be talking about charts. Now, learning how to read a Forex chart is considered to be somewhat of a science, but it's not difficult. They look complicated at first glance. Forex charts can look drastically different depending on what options you may want to use. They also look kind of different depending on what provider or how you're seeing them, whether you're using them on our web-based trader or you're using them on MT4 platform. There's all types of charts, but they all give you the same information. So don't freak out when one looks slightly different than the other. It's just your settings and the graphic designer's layout, but you can make them all do exactly the same. But the best way to trade or to use charts is to find one charting provider, one charting service, or if you're going to use MT4 platform, use the charts on MT4 platform, because they all differ based on the size of your screens and the overall layout. Or you could set them all up to be, like I said, exactly the same using the customized settings. Now, charts usually have settings for display styles, display style of price, time frame that you want to view. Basically, some have as time frames as little as 1 second up to 10 years of historical data, because this is where you would get and see how an asset's traded over a long period of time, allowing you to see how prices moved way back when and how prices were moving last year or 2 years ago or 3 years ago on a chart. Now, price can usually be displayed as a candlestick, a line, or a bar chart. Now, charts are very important because they help you build your roadmap to trading profits. You have to learn the basics. You have to learn to build your foundation, because no matter what type of trader you want to be, whether you're going to trade from fundamental analysis, whether you're going to trade from stock reports, whether you're going to trade from press releases, okay, all of those types of information can only help you decide whether an asset will go up or down. But they can't tell you what price to enter the market. They can't predict what price to exit the market. They can't help you with stop losses and take profits, because all that is based on price action you see on a chart. So charts are integral in not just making trading decisions, but also handling your risk management and deciding what profit you'd like to make. Now, there are 3 basic charts. And all the other charts out there are variations of these 3 types of charts. We have line charts, bar charts, and candlesticks. Now, line charts are the bare basic minimum. A line chart just kind of shows you how price is moving. So what you're looking at on your screen right now is a line chart. And a line chart, the basic explanation is for every time frame that you're looking at. If you're looking at a one-day chart, at the end of that one-day trading, you would put a dot on that chart for whatever the price closed at that end of one day. Or if you're looking at a 15-minute chart, at the end of each 15 minutes, you put that one dot on the chart and you connect them together with a line. They will give you some basic understanding of where price is moving, but they give you no detail that you can really make decisions from. But they let you quickly see what's going on in the marketplace. Now, a bar chart is my favorite type of chart. And as you can see, this bar chart, in fact, all three charts we're going to look at are for the same asset, for the same time frame, for the same prices. So we're looking at the Euro-US dollar on a 30-minute chart on this line chart. Now, this is the exact chart for the exact same period in a bar chart. And as you notice, you get a lot more visual information when you're looking at a bar chart as opposed to a line chart. Now, because this is a 30-minute chart, what that 30 minutes means is every 30 minutes we're putting a bar on the chart that encompasses that trading period. If we were looking at the Euro-US dollar one day, we would put a bar on the chart at the end of each day, and it would comprise of all the price action that happened in that entire day. In this case, we're looking at the 30-minute chart, so each one of these bars tells us exactly what happened over that 30-minute period. So you have a lot more visual information because charts are very visual. Now, a bar chart is sometimes referred to as an OHLC because it contains the open, the high, the low, and the close for that time period in which you're looking at. So again, because our chart is a 30-minute chart, we see the beginning of each 30 minutes, the end of each 30 minutes. We see the highest point that asset traded at in those 30 minutes and the lowest price those assets traded in the 30 minutes. So we have OHLC. So in other words, at the open of each time frame, and if we're using a one-day time frame, it's the beginning of that one-day trading session. If we're looking at a one-hour chart, it's the beginning of the 1 hour. We put a dash across to the left at the open. We then, at the close of that period, so if it's a 1 hour chart, 1 hour later, we put a dash to the right at the close. We then put a dot for the highest price that asset traded at in that period and a dot for the lowest price that asset traded in that 30-minute period. Again, if we're using a 30-minute chart, if we're using a one-day chart, same explanation, but for one day. We then draw a line and connect the high and the low together. And that gives us a bar. Now, if you stepped up from the open to the close, that's considered a bullish time frame because that's telling you that the bulls controlled the ball for most of that market. The opposite is a bearish signal. A bearish signal or a bearish time frame occurs when the open is here, so that's your doohickey to the left, and the close is here. So what did you do? You stepped down the ladder in that time frame. So the bears controlled the overall session in that time period. Okay. Somebody says their sound has gone out. There's nothing wrong with the sound on my time. Let me type in and answer this guy. Hold on. Okay, ladies and gentlemen, I'm going to just make this one announcement. I cannot help you when there are either the screen delays on your side or the sound problems. Please don't make the assumption that it's this side. It is usually on your side. I have all these types of panels and controls and everything showing me what is happening on my side. So because you're receiving it via the internet and it's by your internet provider and your computer, if there's a problem developing, before you start writing me in messages, either refresh your computer, log out and log back in, or check your own sound, because 99.9% of the time, if I'm not seeing a problem on my screen, or in all these meters I have on the screen, it's the problems on your side. Okay, so please, before you start writing me in messages, check your side first. Thank you very much, but because there's very little I can do to help you on your side. Sorry about that. So let's move forward. So when you step down from the open to the close, it's a bearish signal. So you can start seeing or start telling a story about price movement when you look at a bar chart, okay? Because it also lets you compare time frame to time frame. So if we look at here, say let's just take this gap of time here. Okay. Now because this is a 30-minute chart, that's a lot of hours. Or we can take this gap of time here. And what do we see? We see a lot of common prices. We see not only is price stay, but we can actually see where opens and closes or highs and lows had common points. See here, look at it. All of those highs were exactly the same. So that's 2.5 hours where that asset was only hitting that high. You can see that the lows were all the same. You can see the opens and closes. Where on a bar chart, you don't get to see that. On a line chart, you don't see that. Okay. So there's many advantages to a bar chart. Okay. So we've looked at line charts and bar charts. The third most popular type of chart is the candlestick chart. Now, candlestick charts are the buzzword of today's online retail investing. And I can't tell you, I mean, we're actually doing a 2-week course on candlesticks now. The attendance is sky high, but I can't tell you how many traders send me messages saying, Barry, I trade from candlesticks. I'll say, oh, great. How long have you been trading? Oh, I've been trading a couple of days, a week, 2 weeks. I said, that's not enough time to even learn about candlesticks. The fact is, candlesticks are a complex trading system. And they work extremely well, but it's one of those systems that you have to learn. You have to put the time and the effort, because what happens is we're looking at the same chart now for 30 minutes, euro US dollar, as we did for the bar chart and the line chart. Same exact day, time, and everything else. Now, if you notice, if you take the blacks and the reds off the candles, they look exactly like the bar chart. But what happens is we're human beings, and human beings are affected by visual input, especially colors. And too many traders think the red or the abundance of red or the abundance of green are trying to tell you something. And that leads you to false conclusions, because candlesticks are all about the size and the shape of the candle, or it's called the body, and the size of the wicks, and the combination of one, two, or actually 2 or 3 candles next to each other and their placement, and what their shapes and sizes are trying to tell you. Now, if you understand this, and there are 16 basic patterns, but you will hear about all these things from Marubozu to Doji, and you have to learn what these are. In a bar chart, you get the same information, but you're not getting confused by colors, and bar charts don't really tell stories from one. They do tell price movement, but they're not about what Japanese candlesticks are. They're not about these funny presentations of what they were. But candlesticks, if you're going to put the effort in to learn them, are very valuable and very, very good. But if you notice, to draw a candlestick for each time frame, you start out by putting a line across at the open. You put a line across at the close. You put a dot at the high and a dot at the low, and then you connect what's called these wicks to the body. And what do you have? you have virtually the exact same thing you have in a bar chart. You have the high, low, open, and close. Okay. Now, if you remember right, in a bar chart, I told you if you step up the ladder from the open to close, it's a bullish signal. If you step down the ladder, it's a bearish signal. Well, in this case, if we're using greens and reds, if we stepped up the ladder, we would be filling this in with green. If we step down the ladder, we'd be filling this in with red. So with the exception of the red and the green, this is exactly like your bar chart. So why are candlesticks so important? Why are they so valuable? Why are they so popular? Because it is all about the body, the story that's being told with the bodies and the wicks, with one candle next to the next candle with a third pattern candle. Okay. So please don't let yourself get sucked into candles unless you want to learn how to use them. Okay. But it's your choice. Okay, you have a line chart is the basic chart. It's not worth trading from. It's worth, I very quickly look at line charts when I want to understand what's going on with an asset, when I'm real fast coming home from the office and I want to just look at all these charts real quickly, because I'm just concerned with what the story is for the day or for the last couple hours. I'm not really concerned with the price because I'm not looking to trade. I'm looking at economic events. I'm looking at price movement real fast and I can get through them real quickly. But otherwise, I trade only from bar charts. You could trade from candlestick charts. Not a problem. They are great tools. But the fact is I trade from bar charts because when I started trading 40 years ago, we hand charted everything. And most traders in those days didn't trade from candlesticks only because it took too long to draw all those things on your charts. And we were all doing everything by hand. Today, because of computers and the new computerized and HTML charts, candlesticks are very easy. So if you want to learn or come to our class on candlesticks, or you just want to get up and read and learn these patterns, they can be valuable, valuable tools. But once you've decided what type of chart you're going to use, and today also, you can just click a button on your charts and go from one to the next, so it's really easy. But once you've decided what type of chart you're going to use, the second piece of information you have to put together or determine is time frames. And time frames are very important because your time frame, number one, should be tied to the type of trading you're doing. If you're looking for long-term investing, or you're looking to buy Apple and you want to buy it towards its lowest price, then you're going to sell it, you're going to just buy it for your portfolio and you just want it to go up over the next few years, or you think it's going to go up over the next 6 months, looking at it in a 15-minute chart is unimportant to you. You know, you'll look at a daily chart and see where the price pattern is and decide at what price you'll enter the market. If you enter Apple at 120.72 instead of 120.74, it doesn't make a big difference because you're looking for long-term growth and you're looking to sell it a year from now when it hits 200. Okay. But if you're looking to trade Apple in short term and you want to trade it in a CFD and you want to be in it now and out of it later today, you're looking for small moves. So you need to see that you're buying Apple at the lowest point today to sell so that you can get out of it at the highest point. So you want to use a smaller time frame. But the thing is also time frames help you learn the personality of an asset. Because if you were looking on, let's say, a hypothetical bar chart, and you saw that the euro moved from 112.21 to 112.41, and you were looking at a 1 hour chart, you'd have one bar, and you see 112.12 at the bottom of the bar, or at the open, and 112.41 at the close, and whatever the high and the low were. But that was the whole movement for 1 hour. But if you looked at it in a half-hour chart, you might see look at that. It was a half hour ago that it was trading as low as 112.21, but when it opened up this half hour, it opened up at 112.42, and it really didn't go up in this last half hour. So all that movement was in the first half hour. So maybe the bulls are exhausted. So maybe I don't want to get into it. So you've broken it down into segments. But breaking it into too small segments can get you too involved and too complex. But also taking a time to view the euro in a 1 hour and then a 2 or a 4 hours might let you see a little bit unusual things about it. Or maybe if you're looking at gold, might see that every day gold tends to ease when the Asian and the European session overlap, and then tends to climb or recover when your Asian markets have closed. You get to see the pair's personality. Okay, and this is important. So let me pop up a chart in here, and let me just show you in real live charts what we're talking about here. So hold on, I've got some charts ready for us. Okay, so we're looking at right now the Euro US dollar in a 1 hour chart. This is the most current chart of the Euro live trading. Now, we can see in this last segment here on the Euro, we can see where the low was, we can see where the high was. Let me just put a pen on here for you. So we can see where the low was, we can see where the high was. Actually, let me get a color on here that's worth looking at. Okay, and we can see where the open and the close were. Now this line denotes 1 hour of trading. If we go back and click on our time frame, and all the charts, no matter which ones you're using, will have an easy way to change the time. So we're going to go down and click on in 30 minutes. Okay. Now, we can see in the last 30 minutes, it had more activity, or it had a bigger high and a lower low. Still the same price, because all the price movement was in this last half hour of, okay, because the first half hour of this hour, the price was in a lower low and a lower high and stayed somewhat here. So the activity was in the most recent trading period. Okay. Or let's take this segment back here. So we can see all of this emphasis here. Let's just click this over to a 1 hour trade. This is the same time frame right here. Okay. Now, we don't see as much detail as we do. And now when we look at the next hour, look at that. Even though we had this huge movement in this, okay, it seems like the bears were in control because the asset opened here and closed down here. It tells us a better story. If we went back and looked at this, though, in a one-day chart, it's the same price movement, but you don't see it as significant because over on the one day, it had this volatility in the middle of the day, but it wasn't as volatile. As the day moved out, the prices kind of moved back together. And we can actually see after this volatility was over, that price was pretty well steady. Okay. So it lets you see things in different perspectives. So that's why you would want to look at time frames. Whereas if you were trading this euro and you were looking to trade it in a one day and you had to cover your stop losses and your take profits and know what the swing of the marketplace was, well, this is a scary little swing. But when we brought it back down to a 30-minute chart, we could have controlled or seen what our volatility was and where we would have had to enter and exit that asset in a shorter term trade. So this is why you want to use time frames. Now, if we were to click this really easy and click over to candlesticks, now my problem with candlesticks is, besides the interpretation, is it muddies up my charts. I'm not very good with lots of colors. And what happens, all these bodies with all these long wicks over there, it's just difficult for me to see. So I like to build everything at least on a bar chart, and then I'll convert it over to a candlestick. But I can build it and put all of my analysis on and then look for, convert to candlesticks and see if I see any candlestick patterns holding. But again, how and why use a chart are very personal decisions. I'm just trying to give you the basics and letting you understand why you might want to make these decisions. Because there's many different ways to use charts, many different scenarios. We can see up here, this is a beautiful scenario, but this is using a candlestick chart. Now in this case, we laid it on here on a bar chart, and then converted it to a candlestick chart to look for any distinct patterns in those candlesticks to give us entry and exit points. But one of the reasons you want to use charts properly is so that you could drop on technical indicators. So like below, we have our stochastics, we have our MACD. We're looking for something in these indicators to move along with price. We'll also see a 5 Elliott wave pattern on here. We see a falling wedge. Okay, we have a definite support line here. And so what we're doing is we're looking to get information out of these charts. Now, this is a little bit more complicated than a beginner's chart. We also have our Fibonacci levels on here, okay, because you're building a trading system. You're building a trading strategy on your charts. But you don't have to be that complicated. Or, here's a very simplistic look of gold against the dollar using inflation rates out of the U.S. over the last 2 years period. Okay, and it's a simple candlestick chart, but it's a way of establishing a very good price point and support and resistance lines when we had inflation data due out. Okay, and then again, here we have a very simplistic chart that's not very complicated, simply using support and resistance and chart patterns, wedges and triangles to see price movement. Because all you're trying to do is anticipate where price might move and where it might have an action. But before you can do all this, you have to get your basics of charting in. So let's go back into my PowerPoint. Let's talk a little bit more about charting. Now, one of the best reasons to learn how to read a chart properly is so that you can apply technical analysis. Not every trader believes in using technical analysis, but it can be useful, even if it's not your primary method of trading. Technical analysis relies on the price that is on the chart you are using. Now, many charting systems will allow you to add all those technical analysis tools that we were looking at, because the more information you add, the more likely you're going to arrive successfully, because a chart is very much like a roadmap. The more detail you put on the chart, the more likely you're going to get to your destination without getting lost. Now, today, we have GPS. Okay. Again, most of you guys around here probably don't remember when we didn't have GPS in our cars or on our mobile device. Okay. But I remember back again when I started traveling over the world, because I used to do business all over the world, I had a business partner. And my business partner could read a map inside and out. We kept maps in the glove box of the car. I was kind of those guys that would call and get some directions and spend half of my life pulling in a filling station and asking, well, where's this street? Where's that light? Where's this? And getting lost on the highway. So I would leave for a meeting that was supposed to be a half hour away. I'd leave an hour early because I knew I'd get lost. Where my business partner, Peter, he'd open up this road map and this atlas, and not only would he be able to tell exactly where to go, he'd tell you how many lights you got to go, where the gas station was, where the school was, when you pass the hospital, turn to your right, and we'd never get lost. So the more experienced you are at reading a chart, the less likely you're going to get lost, but also the more precise information you have on the chart, the less likely you are to get lost. The more successfully you get to your destination. Because look at the similarity between this roadmap of London and surrounding areas and this natural gas chart. It kind of looks the same. All kinds of squiggly colored lines going all over the place. But if you knew what these colored squiggly lines were and all these circles and all these dots, if you knew what they all meant, you could read this map very well, and you could just as easily read this chart. Looks the same. Or perhaps here. Could be a roadmap. If I told you it was a roadmap, not an asset, and took off the Japanese yen and put on some name of a town, it would look just like a roadmap. Now, one of the most important reasons you want to learn how to use a chart and forget the complex involved technical analysis. Okay? Forget chart patterns, forget MACD and RSI, and forget indicators and oscillators. Let's throw all that out the window. Okay? A chart fits into whatever trading system you're using. And there are two key elements you have to put on this chart that fall under the area of technical analysis, but are very easy to do. And this should be part of anybody's trading system, no matter how you're trading. And this is called trend lines and support and resistance lines. Now, granted, you can use trend lines, support, and resistance to build a whole trading system. But these are the two pieces of information that need to go onto your chart that help you decipher what is going on. You know, whether you want to use all these mathematical formulas and all these complex other things, that's perfectly fine. But a trend line is a basic piece of information. It's called the trend is your friend, is the old adage in the marketplace. Because as well as showing the direction and strength of the current price movement, trend lines also shows potential support and resistance for the trend. So in other words, if price is moving up, you want to know that it's going to continue, or want to estimate that it's continue moving up. And along what path should it be moving? Is it moving on a very steep pattern, or is it moving very weakly? At what point would you or could you predict some type of market action or reaction? Not, will the asset keep going up or will it go down? Can you make profit or can you lose? What price could you expect the market to have some reaction? Whether it continues going up or bounces off of somewhere. If you could predict what point or what price that other traders would start to hem and haw. Other traders might push it up, might push it down. But at that precise point, you're expecting some type of action. Predicting what that action might be or will be is a whole different story. But if you know that the euro is moving about 112.39 today, and your support and resistance, your trend line, tell you that the market should react, do something. We don't know what it's going to do at 112.42. You could be sitting back waiting for it priced at 112.42 and then see what the market reacts to. Because trend lines and support and resistance will help you see or help you build your chart like a million other traders around the world. So support and resistance and, well, trend lines have very strict rules because you want to be drawing your trend line on your chart just like everybody else's. You don't want to have a unique trend line. You don't want to have a customized trend. You don't want to have a personalized trend line because a trend line and a support and resistance level will help you predict or tell you a price point where all those other million traders should react. Again, whether they're going to react pushing the price up farther or whether they're going to react and bounce off it is a different story. You're just expecting the price to react. If you put them on correctly, then it's not a secret. If you know that 112.42 is significant price for the euro, you can then at that price wait for that action and then predict or decide what you want to do based on the market action. Where if you put on these lines that were personalized and your personal line told you should get a market reaction at 112.40 and you're sitting back there twiddling your thumbs because a million other traders that drew their trend line were waiting for the asset to hit 112.42, well, guess what? You missed the whole action because at 12.40, 112.40, you're sitting back waiting for nothing happened. At 11.12.42, you're saying, well, look at that. It jumped off of that price and went sailing up. How come? Because all the other traders were waiting for that price, and you're waiting for a wrong price. Now, trend lines are one of the most basic concepts of day trading or long-term investing, but they also are one of the most powerful concepts. Trend lines have been used for trading as long as there's been markets, and they are well suited for any type of market, whether you're trading stocks, currency, commodities, futures, ETFs, no matter what you're trading. Trend lines are based upon the idea that markets move in trends, sustained movement in one direction and then sustained movement in the opposite. Trend lines show the general direction of price movement, the strength of the current price movement, and where future support and resistance are likely to be located. And where do you put these trend lines? On your charts. And guess what they fall under? Everything done on a chart falls under the study of technical analysis. So guess what? You've already started into the field of technical analysis. Now, technical analysis can be as advanced as you want, or be limited to just reading your chart, understanding what that bar is trying to tell you, and putting your trend line on there. Now, trend lines show three distinct but related pieces of information. They show the direction of the current price movement, the strength, or more precisely the speed, how deep the trend is, and of the current movement, and future support and resistance. If you put the trend line on your chart correctly, when price was moving up, you expect it to keep touching that trend line and bouncing above it or below it. Well, it's moving up, bouncing off of it upward. Now, these pieces of information can be used independently of each other, or they can be used together as a larger trading system. Now, the old adage, which I mentioned before, is the trend is your friend. Now, I'm not going to teach you tonight how to draw a trend line, because that's a 1-hour class on its own, because I need to teach you all of the rules on how to draw a trend line. Now, it is possible to draw trend lines between any points on a chart, and they often look, and this is what I hear from new traders, they often look pretty good. In fact, one of the issues I've been working with newer traders is that they will say, I drew with this line and I like it. I can draw a line, any line I want. Well, yes, you can do that. But the question is, how do you draw a line that is meaningful and that will be best respect the volatility and the integrity of whatever trend might be in effect? So this is the consequences. Now, we have coming up a 1-hour class called The Trend is Your Friend. In that class, I will teach you how to draw a trend line on a chart. We then follow that with a class called Support and Resistance. In that class, we'll learn 3 different techniques of applying support and resistance. My favorite is called eyeballing. And believe me, eyeballing, you can learn and have it down pat in one class, and you'll be understanding and drawing these support and resistance lines. And with your trend line, you can at least then predict where you might have price movement. It will also help you decide where you might want to put your stop loss, because if you're buying an asset to go up, you might want to put your stop loss based on the trend and the support level below it. You might want to help you predict where you want to put your take profit point, because when it moves up to its next resistance level, you're expecting it to bounce off of that resistance level. Okay. So once you understand and put these concepts together, you can start making much more educated trading decisions. So what I would suggest to you, we teach these classes in a set order. We start out with basics on charts. We go from there to the trend is your friend, then support and resistance, and then adding GAN fans and other indicators onto your charts. We have our class in what is technical analysis, which we'll talk about what the difference is between oscillators and indicators, what's considered a leading indicator and a lagging indicator, what's called a bounding indicator and a non-bounded indicator, so that you understand and have the basic concepts. So when you're looking at this and everybody's talking about RSI and stochastics and MACD and Bollinger Band, you understand what the differences are. Not what the differences are in the names of what they are or the strategy. You understand which ones are bounded, which ones show you overbought and oversold situations, which ones will show you are leading indicators, which are lagging. Leading indicators predict the market, lagging indicators support the price move. And you'll understand what they are, so that when you see these, you know what groups they fit into and why they're important to you. And my recommendation to everybody, if you're newbies, or if you just don't use charts yet, is to take one asset. Okay. If you want to go to Australia on vacation, take the Australian dollar. If you like gold, take gold. It's not for anything you're going to trade. It has nothing to do with trading. It has to do with learning to read your roadmap. Take this one asset. Start looking at it all week long, several times a day. Look at it on the charts. Keep your charts up. Move from the candlesticks back to the bar charts. Start to look for similarities. Look at it several different times a day, and then look at it in different time frames. Start to learn their personalities. Imagine, again, if we're dealing with a roadmap, if you know that this highway is always busy from 2 to 4 o'clock, but if you leave your office before 2, you can beat the rush hour traffic. Or, you know, if you're not you want to stay in your office till 7. Or if you take the surface roads from 2 to 4, they're going to be faster. But if you stay off 3rd Street because that's where the school is and they're all got it blocked up, this is just like a chart. These are the personalities. These are what you'll start to learn. You'll start to see that, oh, gold is usually higher at this time of day. The euro trade's higher at this time of day. We have more volatility in these hours. And you see this on charts. Once you kind of get to understand this, then you'll start putting your trend lines on this chart. Okay. And then you'll put your support and resistance on. And you'll start, once you've built this chart, because your trend lines, and then we might do trend channels, because you'll set them up in the colors you understand and how you like them. Then your support and resistance, and I'll show you how you put the several different ones, and you pick and choose the colors so that when you look at these lines, they don't confuse you. They're in the colors your mind is used to. So you might use, reds for the nearest support and resistance and blues for the next level. It's what you're comfortable with. But once you do this and we come through the classes, at the end of the class, you'll have one chart that's fully detailed. Once you've done this on one chart, you got it all fully worked out and kind of understand that asset, you'll be able to apply it to all assets, because you're also going to learn that trading takes time. And if you put your time into charting and everything else, you won't spend your time making lots of foolish trades, because you'll spend your time making a better decision. Okay, and I find sometimes I don't get a trade in all week long, because a lot of times the charts will tell me not to trade. I won't see an opportunity. You combine that with your risk management, and you're just not enough profit to be made in that trade. And you might say, it's too much risk or too little profit, so I'm not going to make it. But you'll get this from your charts. You'll also find that charting will keep you busy, so you might decide to limit the assets you want to trade, because that's the first thing that's important, is limiting your assets. Too many traders I see are trading everything. They're not an expert on anything, and they trade everything and anything. I have a friend that tells me he trades from VWAP. Anytime VWAP gives him this, he makes that trade, and he'll be on gold one day and a stock the next day, and he knows nothing about it, and he loses all the time. And I can't hit him on his head and tell him he's an idiot. He's my friend. So I just shake my head and say, make smaller trades, spend more time learning, and I let him go. But the fact is, if you spend your time evaluating the markets and get the enjoyment out of that, as opposed to just trading the markets, you'll find that you can stay in this industry for a very long time. And you can slowly turn successful and make good profits. But it takes time to do this, and it takes time learning your foundations and building the steps. So on that note, I'm going to say goodnight to everybody. I'll see you on Wednesday. I don't know what I'm teaching this Wednesday, but you can find it on the ETX education calendar. And thank you very much for joining us. Thank you for being part of the ETX family. And once again, we'll talk to you again real soon. And good luck trading this week. I don't even know I haven't even looked at what's on the calendar this week. So have a great trading week, and I'll see you next week, and we'll get you moving across this. But pick one asset. In fact, if you come to class on Wednesday, I'm going to ask you all what asset you picked, and you can write it in. Let me know what asset you decided to spend some time learning. Thank you very much. Have a great weekend. Enjoy the rest of your Sunday, and we'll talk to you again. Bye now.